All right, net working capital. We talked about this, right? What is net working capital? Excuse me, guys. Pay attention over here. What is net working capital? Woodbridge, are you here?
Yeah, we're here. Yeah.
Okay. Current assets minus current liabilities. Okay. So here's the formula. Net working capital is current assets minus current liability. And by the way, what is working capital? These are the current assets. Why do we call the current assets as the working capital? Because this is what we normally deal with. We normally deal with cash. We change it to other types of assets, and we're dealing with that type of. We deal with the inventory, always buy, sell, and all those. So we are normally working with our current assets. Working with our current assets, and we are working through our long-term assets. So you may say something like that. But the term of net working capital is the difference between the current assets and current liabilities. Now, why is this important to calculate? Why is this very important? Yeah. Woodbridge, do you want to say something?
No, sir. That's good.
Okay. All right. So, net working capital usually grows with the firm. Now, why is this important? This is important for our need for external finance. That as your business grows, more customers mean more business. As your business grows, your current liability increases proportionally. Similarly, if you buy inventories from suppliers, okay, if you buy less, they say, okay, you will get 50% of the inventory on credit. So as soon as you buy more inventory, the accounts payable increase with that. But of course, your need for the net working capital also increases. We will explain that with an example over here. So this is the same balance sheet that we discussed last week. And I told you that we will be dealing with the same balance sheet for quite some time, in same income statement, by the way. So let's look at this now. What is the situation? Can you guys calculate the net working capital for 2011? I need the answer from Woodbridge. So, net working capital for 2011, and then we also need that for 2012.
707.455.
You say 707?
707 from 2011 as the current assets minus current liabilities 2011, which is 455.
Okay.
Okay. So let's do that. The total current assets are these for 2011. And current liabilities are these. So you subtract these two. 250. For 2011, how much? 252. So our need for net working capital is 252. What does that 252 mean? That means like we have a total of 707 current assets. Like our total current assets are $707. But we only need $252 from our own pocket. The remaining has been financed by the current liabilities, by the restaurant, by the supplier, by the other guys. So that we have to make the difference. Now, what is the net working capital for 2012? Again?
275.
Okay. That is 275. What is the difference here?
23.
Okay. The difference is 23. Now, what does that mean? Imagine that we are right at 2011, and we are smart enough that we can project our 2012 in balance sheet as well. So our 2012 balance sheet is just a projected balance sheet. Okay, based on our estimation, based on calculations, the 2012 balance sheet is a projected one. What does that mean? Is that our business is expected to grow from 2011 to 2012, and that will result in an increase of $23 million in net working capital. In other words, we have to make borrowing arrangements or maybe an equity arrangements for the $23 million for the next year in order to support this growth. If we do not make that arrangement in advance, we may get in trouble. And this will stop our growth of the business. We're going to discuss these models later on in more detail. But is this clear so far? Yes. Okay. All right. Okay, that's already been done over here, so you can look into that. It's the same thing. $22 million. We've done it correct. You're smart guys. Okay.